Welcome learners. So in the last video, we have completed an overview on financial statements of a company. So in this video, we will start the practical aspects of financial statements of a corporate organization. So financial statement, the final product of accounting process and prepared following accounting principle, practices and accounting standards. According to section 129 of the Company Act 2013 prescribed that balance sheet, profit and loss account and are prepared in the prescribed schedule 3rd of the Company Act 2013. A set of financial statement as per under section 240 of the Company Act 2013 includes first is balance sheet, profit and loss account, notes to accounts and cash flow statement. So first of all, balance sheet. Balance sheet is a statement of assets, liabilities and equity. Equity means shareholders funds or we can say internal liability of a company at a given date. It shows the financial position of a business by listing its assets, equities and liabilities. It is also known as positional statement or position statement. So this is the meaning of balance sheet here. Now, profit and loss account. So balance sheet is a position statement and profit and loss account is income statement. Because profit and loss shows the financial performance, that is result of the business operation during the accounting period from April to 31st March. It is described statement of profit and loss account part 2nd of schedule 3rd of the Company Act 2013 and also known as income statement. Notes to account, balance sheet and statement of profit and loss account are supported by notes giving detail of item in the balance sheet and statement of profit and loss account. So notes to account, balance sheet and statement profit and loss account are supported by the notes giving details of the item in the balance sheet and profit and loss. Next is cash flow statement. Cash flow statement, it is a statement prepared in the manner of prescribed in as per accounting standard 3. Cash flow statement shows inflows and outflows of cash or cash equivalent. Mean to say how much cash is inflow and how much cash is outflow during the particular period. So financial statement provides the summary of accounts of the business enterprises. Now, characteristics of financial statement. Financial statement relate to the past record. Thus, it is called historical documents. They are expressed in monetary terms. They shows position through balance sheet and financial performance through profit and loss account. Next is characteristics of balance sheet. Balance sheet shows position of a company, specific point of time. Mean to say position means what are the assets, what are the liabilities and equities. Two part of the balance sheet show always match. Mean to say assets is equal to liability plus equity or liability plus capital. It is prepared by taking balances of assets, liability, and equity. Equity means shareholder funds as on the date when it is prepared. The accounts in which balance sheet may have an opening balance, transaction during the year, and closing balance. Mean to say there will be opening balance in balance sheet plus during the year purchase, then closing balance. Mean to say if building in opening in starting of the business, building is for rupees 1 lakh, and purchase of building during the year 50,000, then closing balance of building would be 1 lakh 50,000. Now, characteristics of income statement, profit and loss account. So, financial performance of the company will show by the income statement, just like your revenue, expenses, profit or loss for the period. It is prepared for past period. Thus, it is called historical document. It is for specific accounting period. Now, this is the format of a balance sheet of a company. Balance sheet of a company, it is just like the balance sheet of individual, but the format is different. In particular column, upper part is concerned with liabilities and equities, and lower part is concerned with assets and current fixed assets and current assets. So this is the current year assets and liabilities. This is previous year current assets or all assets and liabilities. So first is equities and liabilities. In equities and liabilities, first of all, there will be share capital. It is the previous year's amount and it is current year amount. Second one is reserve and surplus. Third one is money received against share warrant. Second part is, second subhead is share application money pending on allotment. We will discuss it later. Third point is non-current liability. Non-current liabilities are liability payable after 1 year, like long-term borrowings. Borrowings means loan. Deferred tax payment. Other long-term liabilities. Long-term provisions. Now current liability. Current liability is payable within a year, like your short-term borrowings or loans. Trade payable, creditors plus BP. Other current liabilities and short-term provisions. This is the total of liability side. Now, asset side. There is non-current assets. First of all, in non-current assets, first part is fixed assets. Fixed asset, it is tangible asset like plant and machinery, building, vehicle, furniture, tangible. Tangible assets are those assets which we can touch. Intangible assets are those assets which we cannot touch, we can feel only, like goodwill, trademark, capital work in progress, intangible asset under development, then non-current investment, then deferred tax asset, long-term loans and advances given to other person, other non-current assets. Now current assets. Current assets are those assets which convert in cash within a year, like your current investment, or you can say short-term investment. Inventories means stock. Trade receivable, debtors plus BR. cash or cash equivalent. Marketable security include in cash equivalent also. Short-term loans and advances, prepaid expenses, extra, or other current assets. This is the total of assets. So this total should be equal to liability side. If the total of liability side is 20 lakh, then total of asset side also 20 lakh. Now we will discuss equities and liabilities. So equities is the liability towards shareholder, or we can say owner. It is termed shareholder funds. It includes share capital, reserve and surplus, money received against share warrant. Mean to say, these are our internal liability. It is the amount invested by owner, you can say. The term liability means the external liability. Liability towards outsider. It is shown as non-current liability and current liability. So external liabilities are two types. Non-current liability mean to say liability payable more than after 1 year, and current liability which is those liability payable within a year. So first of all, we will discuss shareholder funds. So shareholder fund includes share capital, reserve and surplus, money received against warrant. So let us discuss in detail share capital. So share capital means the amount received by the company against issue of for subscription, or also share issued for consideration other than in cash. Share may be issued in cash or may be issued for consideration other than in cash. Suppose I purchased building from you for rupees 20 lakh and I am issuing share in place of cash to you. Mean to say, I am paying the amount of building in the form of share capital. This is called share issued consideration other than in cash. The person to whom share are allotted known as shareholders. There are two types of shareholder: equity shareholder and preference shareholder. So Schedule 3 of the Company Act 2013 required the balance sheet to disclose so authorized capital, issued capital, subscribed capital, and amount of called up capital of the company and paid up capital by the shareholder. Details required to the schedule are given to the notes to account on share capital. Notes to account are prepared for the detail of authorized capital, issued capital, subscribed capital, amount called up by the company, and amount paid up by the shareholder. So first of all, we will discuss authorized share capital, nominal share capital, registered share capital. So authorized share capital or nominal or registered capital, authorized capital or nominal registered capital is maximum capital that company can issue for subscription. It is started in memorandum of association of the company under capital clause, is divided into different clause of share such as equity and preference share capital. It is the maximum amount up to which a company can issue under each class of share capital. That's why it is called authorized share capital. So definition of authorized share capital as per section 28 of the Company Act 2013. Authorized capital means such capital as authorized by the memorandum of association of the company to be maximum amount of share capital of the company. Now issued share capital. Issued share capital is the part of authorized capital which the company has issued for subscription up to the date of the balance sheet. Share issued under each class of company giving a number of share issued and their nominal value is shown in the notes to the accounts of share capital. It should be kept in the mind issued capital can be equal to or less than the authorized capital. It is not more than the authorized capital. So definition of issued capital under section 250 of the Company Act 2013, issued capital means such capital as the company issued from time to time for subscription. Now subscribed share capital. Subscribed share capital is the part of issued capital which has been subscribed. Amount received by the company whether in cash or kind, as the subscribed capital is shown in the share capital on the face of the balance sheet. Definition of subscribed share capital is as per to section 86 of the Company Act 2013. Subscribed capital means such capital, the part of the capital which is for the time being subscribed by the member of the company. Subscribed capital may be subscribed and fully paid up, subscribed and not fully paid up. Subscribed and fully paid up, the example for this is, for example, company issued 1 lakh equity share at the rate of 10 each and has called the nominal, company has called 10 all amount, then it is called subscribed and fully paid up. On the other hand, when company called, suppose company have 1 lakh equity share 10 each and company called 7 out of 10. It means 3 is non-called up capital. So this is called subscribed and not fully paid up. Now called up share capital. Called up share capital means the amount called up by the company to be paid by the shareholder towards share capital. For example, company subscribed 2 lakh equity share of rupees 10 each, which the company called only 5 per share. So called up share capital is 2 lakh into 5, 10 lakh. Definition of called up capital is as per under section 215 of the Company Act 2013, such part of capital which has been called for payment. Next is paid up capital. Paid up capital means the amount received by the company against the share capital and credited to share capital. It includes the amount credited as paid up share capital account without payment being received in cash. For example, if company purchasing machinery 10 lakh and issued fully paid share to vendor, vendor means seller of the machine, the company will credit 10 lakh to share capital paid up, and also reissued forfeited share at the rate of 3 per share discount. So definition of paid up share capital is, paid up share capital means such aggregate of the money credited as paid up as equivalent the amount received as paid up in respect of share issued, and also include any amount credited or paid up in respect of share of a company, but does not include any other amount received in respect of such shares by whatever name called. So in this video, we have covered about share, various types of share capital,